Be Wealthy and Smart, episode 1183.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to answer a listener question about what percentage should you have of bonds in your portfolio. Now, this is on a lot of people's minds as they are approaching retirement, as they're seeing their life change. Maybe they're going to get out of the corporate world, not have that income from work anymore, but they are going to start drawing on their portfolio, start depending on it for income, and they're thinking about what kinds of changes should they make. Should they become a lot more conservative? Should they try to protect what they have? Or is it important to have some growth in your portfolio? So we're going to discuss this today. The question came to me and it said, when do you start allocating to dividends, bonds, savings type of investments? I've been reading that in my 50s, I should be moving from growth stocks to more stable dividend payers. And in my 60s, I should part ways with volatile growth stocks. Is there an asset allocation you like for those getting ready to retire soon? Well, I definitely have opinions about this, but there's no one right answer, and the answer for you is probably within a range of solutions. So let's talk about what that means. First of all, you want to start with your risk tolerance. How tolerant are you to fluctuations in the market? Now, nobody likes fluctuations in the market. Nobody was happy that the stock market was down last year. That's never fun, and that's not what I mean. But what I mean is, what's your attitude about coming back from a down market? Are you the kind of person that has confidence that the market will come back and recover? Or are you the kind of person that's pessimistic and is the type to, once the market's down, put your money into cash and hide out thinking that the market will go down again? You have to understand your personality and your level of fear with the markets and your level of experience investing. People that have been long-term investors understand that every so often the market does have a bear market year like we had last year. But it also means that the market is likely to recover and have a big year somewhere in the near future as those companies bounce back and regain some of those losses. We saw, for example, last year tech stocks really sold off hard, but guess what bounced back strongest this year? The NASDAQ. It's handily outperforming the S&P 500 and the Dow. And year to date, the NASDAQ is up 16%, while the S&P is up half of that at 8%, and the Dow Jones Industrial Average is up only 2% for the year. Those people who were able to hold their technology stocks through last year's downturn have already recouped 16% this year. So you have to know your risk tolerance, and are you able to hold through uncertain times for better days ahead? You also want to look at what is your age, because as this question is set up for us, we're talking about 50 to 60-year-olds, but what if you're in your 20s? How should someone in their 20s be investing? Well, many people believe that if you're in your 20s, you want to have 100% of your portfolio in equities, stocks. It can outperform. And because you have 40 years until retirement or so, you want to have full-on growth potential in your portfolio. I think that's also true in your 30s and 40s, but some people might start to put 10% or 20% of your portfolio into bonds at that time. When you reach your 50s, some people think 20 to 40% maybe in a bond portfolio, and maybe when you get to your 60s, 40 to 50% in a bond portfolio. Then once you retire, maybe 60 to 70% in bonds. But here's the problem. Bonds are not a perfect investment. In fact, bonds have a lot of flaws. First of all, they're guaranteed to give you low returns. That's right, you're guaranteed to get whatever the coupon rate is on the bond as long as you hold it till maturity. So if your bond is paying 4%, you're guaranteed a 4% return. If the stock market goes up 15%, well, that's too bad. If you were invested in bonds, you get a 4% return. So you're guaranteed to have lower returns in bonds because over time, bonds perform at much lower compounding rates than stocks do. And this is a problem with people who are too conservative, is they're not able to compound at very high rates because they have too much of their portfolio in bonds. So some people think that's more of a risk than having your portfolio in too much stock. You also have interest rate risk with bonds. That means as interest rates rise, bond valuations decline. In this rising interest rate environment that we've been in for the last 18 months, as interest rates rise, bonds have dropped in value. That's because bonds have an inverse relationship with interest rates. So anytime interest rates go up, the value of the bond drops. That's a function of how bonds operate. Bonds also don't keep up with inflation. Most bonds aren't indexed for inflation, so you have a fixed rate that you're receiving even though inflation keeps increasing. Now, in our Treasury inflation-protected securities, you are able to index that with inflation, but often the index doesn't keep up with real inflation. So the real world inflation, for example, groceries, can be something around the neighborhood of 15 to 20% that we've seen in the last year on some groceries, but our inflation rate that we're talking about is around 5%. So the index would give you a 5% increase for inflation, but that might not cover what you're really experiencing in the real world. You also have credit risk with bonds. So if you're in corporate bonds, for example, depending on how the corporation does that issued the bonds, if they have financial problems, or if you're in high-yielding bonds of a corporation that have poor credit, for example, and a balance sheet that isn't looking so good, so they have to pay higher interest than the going rate on bonds, they may be more at risk of default, and you could actually lose your money due to debt defaults. So bonds are not a perfect panacea that sometimes people think they are. You think you're going from some sort of a part of your portfolio that fluctuates and can lose money to something that's going to guarantee that you're going to make money. And that's not actually the way bonds work. Yes, if you hold them to maturity, you can be guaranteed that the bond will pay the amount of principal plus interest that you invested. But if you're invested in a mutual fund, for example, you still can lose money in a bond fund. And many bond funds did very poorly as interest rates rose and have in the past done very poorly when interest rates have risen. So you can lose money in bonds, and that's something that people really need to understand. And the longer the maturity of the bond, the more that you can lose, because the more it will decline as interest rates rise. Versus if you have a short-term bond, one that's issued for 1 to 3 years, it won't decline very much if interest rates rise. But if you have a 30-year bond, that will decline the most as interest rates rise. So understand that there are limitations that bonds have. They're not a perfect answer to retirement income. And what you probably want to do is diversify your portfolio. So you do have some dividend-paying stocks, like I talked about in the podcast immediately prior to this one. I talked about the 4 different ways of earning income, and one of those was to have dividend-paying stocks. That will give you growth in the portfolio because you're invested in stocks, and it will also give you additional income because those stocks pay dividends and have a long history of paying dividends. Some have paid increasing dividends for 40 years. So a portion of your portfolio in dividend-paying stocks or in NOBL, the Dividend Aristocrats ETF, my favorite, might make sense for you. Having some in a short-term, intermediate-term, and long-term bond fund portfolio might make sense for you. Having some in the Treasury inflation-protected securities portfolio issued by the government might make sense for you. These are all things that you can diversify your portfolio with, and that helps you diversify some of the risk and limitations that bonds have. But the more important conversation is why it's still important for you to have stocks in your portfolio even during retirement. And that's because stocks do perform over time at a much higher compounding rate. So you're able to grow your money faster in stocks if you keep a certain percentage of your portfolio still in stocks after retirement. I think that's really crucial. And now that we have inflation, you're needing to get to those higher compounding rates to outpace inflation and maintain your purchasing power. That's really important too. You also don't want to outlive your money. And by having all your money in low yielding bonds, you're only able to draw 3 or 4% per year to make sure you don't run out of money in your retirement plan. Well, you better earn more than that if you're taking out 4%. You don't want to earn 3% and take out 4% out of your portfolio, because you definitely will run out of money doing that. You want to be earning more in your portfolio than what you're drawing out of it. So you want to earn 10% in stocks and draw out 4% in income. You also want to look at what's the longevity in your family. If your mother lived to be 100 years old, you better plan to have growth in your portfolio even in retirement. You're going to need to get that growth to keep your portfolio growing. And because of that longevity, you're going to have that portfolio longer. It's even more important for you to have growth in your portfolio, and that comes from stock investments. Now, it's my opinion, looking at cycles, that we're going to have a very strong stock market for the next several years, and it's quite possible that the low was in the second year of the decade, which was last year. I believe the lows are behind us, and the October lows will hold, and from here forward, we may have several good years of investing as inflation trends lower and interest rates trend lower later this year. That will help housing, that will help corporate profits, that will be good for stocks. It's not a straight line up, it never is. It's always going to be scary, and it's never going to feel good or for certain. Bull markets climb a wall of worry. That means you're scared the entire time that the market's going up. When you feel confident that you're sure the market's going to go up, that's usually when we're at the end of the cycle, and the market can often turn and have a sharp correction like we had last year. With investing, we always want to take a long-term view. And long-term, I believe it's important to have a portion of your portfolio in something that will grow and something that can get you higher compounding rates. That's so important to still have growth in your portfolio and not get all caught up in, oh, I'm in retirement, now I need to, quote, protect my portfolio. Remember all the weaknesses I told you about bonds. You're not really protecting yourself as much as you think you are when you have purchasing power risk, when you have interest rate risk, when you have guaranteed lower returns. That's not protecting your money. That might be making a very big mistake with your money. The most important thing that you can do is maximize the growth in your portfolio. The key is to do that in a way that you're not taking more risk than you're comfortable with, but you're taking enough risk that you're going to benefit from it. Whether that's 70% in stocks and 30% in bonds, or in retirement, 60% in stocks, 40% in bonds, or for some people, 80% in stocks, 20% in bonds. It just depends on your level of comfort, your level of investment experience, and your understanding of the importance of growth in your portfolio. One of the biggest mistakes that women make is not liking risk, and therefore guaranteeing themselves lower returns by putting too much in bonds, not enough in stocks, and not getting the growth in their portfolio, and not getting their portfolio to the amount they need for retirement, and then living this long life and not having enough money. That's the worst case scenario. You definitely don't want to get yourself in that situation. And the way to not get yourself in that situation is to focus on growth, to focus on having enough in stocks so you can get to 10% average annual returns in stocks and therefore continue to compound your money over time. That's what's going to create wealth for you, is being in something that has growth potential, which is why we invest in stocks, which is why we invest in cryptocurrencies, which is why we invest in private equity. These are all things that are going to grow your money and make sure that you have enough money and don't run out of money. That's the important piece of your portfolio to really focus on. So I hope I answered your question and you understand the importance of maintaining growth even in a retirement portfolio. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly investment newsletter for more wealth. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.